Hello and welcome along to the Property Academy podcast by Urbis Partners. I'm your host, Steve McKnight.
And I'm Andrew Nicol.
And today on the show, we're talking about the 7 reasons not to invest in property right now. And this is really fascinating because I recently got an email from a listener of the show and somebody who is a property investor talking about that the market really sucks at the moment and what they're going through. Now, make sure you stick around for the next 15 minutes because we're going to talk about the number one biggest thing going wrong in the property market at the moment. We're going to talk about the 7 reasons not to invest. And all of this is so that you can listen to some of our other shows and create your own more balanced opinion. Now, Andrew, I'll read you the email that I got from property investors. His name's Colin, and he's feeling what a couple of investors will be thinking at the moment because I think his property's in Auckland, and he's just had to drop his rent from $680 a week to $660 a week, down 3%. And one of the comments he'd made was, so much for greedy landlords and soaring rents. We're taking a bath and rents are going down, not up. Not exactly a sustainable business model at the moment. Not sure how other landlords are faring, but OPA's, i.e. our company's, relentless positivity of the market is very much at odds with our current experience. And I really want to answer this because this is an upbeat, energetic show. If you want to hear all of the bad things going on in the world, go to the New Zealand Herald and stuff.co.nz because we're often trying to look at the good things and what are the opportunities right now, because that's what people tend to like. And we have written some guides around like all of the things that can go wrong in property investment. And we never want to provide a one-sided view on this show, which is why we talk about the 7 problems with new builds or the 6 things that are wrong with townhouses, but also how to fix them, looking at kind of both sides. But I thought what we'd do at the risk of coming across as overly negative is let's talk about all of the bad stuff or the 7 bad things that are happening in the market at the moment. That way you can listen to this show and also one of the previous ones where I talked about why am I spending 7 figures on a house right now for myself, because I think it's a really good time to invest. But let's look at all of the bad things. Now, Andrew, kick it off for us. What is the number one bad thing going on in the market? What's the number one reason not to invest right now?
I think the real challenge is around tenants at the moment. So Colin's exactly right, particularly if his property is in Auckland. The rental market is very sluggish there. So we've come out of winter, which tends to be pretty sluggish, but this one's been particularly bad. And in fact, I've had property managers say to me it's the worst they've seen in their career kind of thing. And I think a big part of this comes down to the Auckland floods. So there was a major shortage, like overnight, right? You have houses that were damaged, like the Christchurch earthquakes. You have people who were never going to be tenants again because they own their own house, all of a sudden have to be tenants. And that puts a huge strain on the rental market. Then, as houses get repaired and people build new houses or repair their existing house, move back into their properties, now all of a sudden there's a bit of an oversupply. And so you've got more supply in the market and less demand. Now landlords who have been able to get maybe a premium on their rents have had to drop a little bit, or they're getting a little bit more vacancy. So we're noticing kind of an extra couple of weeks vacancy when we find an initial tenant at the moment. So finding your first tenant or keeping your existing tenant is a little bit hard at the moment.
Yeah, and we see this in the numbers as well. So if we look at Tony Alexander's survey of property investors, we see a net 22% of property investors are saying it's actually hard at the moment to find good tenants. It's harder than usual. And we can see that over time, sometimes it's pretty easy to get good tenants. Sometimes it's really hard. And at the moment, it's one of those hard times. Now, it won't be hard forever, but at the moment, it absolutely is. Now, I wanted to dig into this a little more because when we look at kind of the national data, for a lot of places, rents are flat. So they're not increasing, they're not decreasing. But I went and looked at our property management data for our Christchurch team. And what I saw is that for most people, the rents are staying exactly the same when they're coming to find a new tenant for their property. But a couple of people are increasing the rents by $20 a week, and a couple of people are decreasing their rents by $20 a week. So it kind of averages out at that zero. But for some people, especially the ones that are having to drop their rent, then yeah, it really does feel like it sucks at the moment.
Yeah, and those people will be the ones that are feeling like the market's going to hell in a handbag. Meanwhile, the other ones are creeping up a little bit. So it just shows that averages can skew it a little bit.
Now, the second reason is that there's no clear trend of property prices absolutely increasing at the moment. Now, this is one of those times where you can look at the same graph or the same data and get a different view. So, if we look at how much house prices have changed over the last 3 months, in August, they went up by 0.1%. In September, they went up by 1%. And in October, they went up by 0.5%. Now, the positive way to view that would be to say, well, that's great. Over the last 3 months, house prices have increased by at least a little bit in each month. But one thing you could also do is look at October and say house prices went up by 0.5%. That is less than what you'd usually see in October. I think the median for October is up something like 0.7%, maybe a little bit more than that. But it is lower than what a normal October is. So if you wanted to look at the house price data, you could definitely look at that and make an argument and say, well, the market's just kind of going sideways. Like, yes, we've had a couple of months where house prices are increasing, but it's summer. Generally, house prices heat up in summer. What's going to happen next winter? I think it's fair to say that there is no concrete, absolute slam dunk, bam, the market's back evidence at the moment. So I think you could look at that and make that argument.
Now, just as we're going through this, I do realize that we are talking about everything with extremes today. Like this is all the bad stuff. This is the stuff that would stop someone investing. Now, if you're right now thinking about investing and you're listening to this going, holy hell, this is way too scary, just remember that right now we're in a buyer's market. So that means that you're probably going to get a really good deal. But as a result, the reason you're getting a good deal is because lots of other people are going, this is a terrible market. So the reasons that you get a good deal are the reasons why you might not invest at the moment. And you should go back and listen to Ed's recent podcast about why he's buying a house right now, right?
Yeah, and I also recently wrote a One Roof article about the 7 reasons why I think it's a great time. But this is to provide the balance that some of you guys are saying, hey, I want you to talk about all of the bad things. So because you've asked about it, here we go. Now, reason number 3, Andrew.
Reason number 3 is cash flow. So again, this kind of goes with, okay, I might be reducing my rent a little bit at the moment. My interest rates are, they're coming down, but they still suck. So if cash flow sucks right now, how long is it going to carry on that I'm running, I think Colin said, an unsustainable business model, right? You're just putting good money after bad.
Well, I think the main thing as well is if Colin's seeing his rent go down by 3%, obviously if rents continue to go down by 3% every single year, if he has to reduce his rent by $20 a week every single year for the next 20 years, then all of a sudden his rent's going to be about $280 per week. Now, that is highly unlikely to happen. So it would be unsustainable if rents continue to go down. That's probably unlikely to happen over the long term because what we know is that property prices and rents tend to increase over time as incomes increase.
Yeah, so this is where Opus Plus is a really good tool for anyone wanting to kind of get a sense of where their cash flow might be heading over the next few years. And again, this is using a bunch of assumptions. And the thing about assumptions is they're a best guess and they're going to be wrong. But we can use some common sense around that. And you can also make these as optimistic or as conservative as you want. So just looking at cash flow right now, if you're borrowing 100%, so you're using the no cash needed method to buy a rental property, you should expect to top up the rent. So the rent won't be enough to cover all of your costs. If you're being true with yourself and saying, okay, well, we need to factor in maintenance and vacancy and the rates and the insurance and accounting, all of those costs. So just to kind of put into perspective, right now, just purely as an example, you might be topping up a property by $450 a week over and above the rent. Now, next year, as interest rates trend down, with some rental increases expected, that's probably going to go down to closer to $250, and then the following year might be closer to kind of a $200 a week. Now, just remember, this uses a bunch of assumptions. So if you want to change those, in Opus Plus, you can go through and change from what we use as default assumptions, and you can change your long-term rental inflation rate to, say, 3%, for example. If you want to be a bit more conservative, you can update that.
Oh, I'm updating it. Sorry, Andrew.
By clicking on the button.
I was off in La La Land thinking about the
How good
things.
this is. And then you can also change the interest rate. If you want to be a bit more conservative on your interest rate next year, you don't want to use our assumption of 5.3, you might change that to 5.5.
And then the other reason is just the fact that affordability is really stretched at the moment. So if we start looking at, and I'll jump into the Infometrics website, into the back end, you can see what us nerds actually look at. So if we look at housing affordability, at the moment, the average house is 7 times household income. Now, that is up from, if we go back to, say, 2010, the average property in New Zealand was 5.1 times the average household income. And so houses have become less and less affordable over time. Now, one way to read that data is to then say, well, housing affordability is very stretched. How much can house prices really go up into the future? And some people will look at that and say, I don't have a lot of confidence that house prices are going to continue to increase at a rate above household income increases because housing affordability is so stretched. And I know that those two guys on the Property Academy podcast will look back at 2022 and say, yeah, back then housing affordability, average house was 8.7 times household income, but that was unsustainable, which is why house prices have come down. And so there is definitely an argument to be made that because housing affordability is stretched, how much can house prices really go up into the future? And now, of course, there is another side to that, which we've covered in other episodes. But again, today we're specifically looking at the reasons that you could find not to invest. What's number 5, Andrew?
Number 5 is an interesting one. It's the Trump effect. And I read an article in New Zealand Herald just recently talking about now that Trump is president-elect, when he comes into power, is he going to introduce these tariffs, have an inflationary effect on the market? Will that cause our interest rates to go up? And the answer is it possibly could, but I do think this article was a bit of clickbait. Like, surely Trump has got to be the number one thing Googled over the last wee while, right?
Yeah, there is one thing I would say to this as well, which I think I talked about in a recent YouTube video. This article was talking about a company called BMI, and they're talking about how much our economy is going to grow. And they said, according to their new stats, our economy will grow just 1.8% next year, down from a previous forecast of 2%. And so I thought, okay, so if our economy is growing by a difference of 0.2%, how much difference does that make to the average person in New Zealand? Do you want to have a guess per week what that means for the average person in New Zealand?
I have no idea. This is one I've got no yardstick. You tell me.
It's $3 a week.
Oh, no, I can't do that.
Yeah. And so this was a really interesting one that you're like, oh, okay, our economy's not going to grow, but the difference is $3 a week. It's actually very, very immaterial once you break it down. But I've committed to only talk about the bad things. So, Andrew, let's continue on. Another one is developers going bust. And this could be a risk specifically for new build investors. So classic builders, they are quite a large developer around New Zealand. There was an article talking about that they have cut 90 staff over the last few years. They've really, really downsized. We saw it with Citadel Capital, Andrew, as well. The IRD is applying to shut that developer down. And recently on one of our webinars, we talked about Stonewood Homes, that they've gone from a peak of about 800 houses per year down to under 80.
And it's crazy.
Yeah, I think that was over the last decade or so. So we've seen some big contractions from developers. Now, the risk for a new build investor, if you get that wrong, is that you sign up to buy a property from a developer that then goes under, and then they're not around to finish that build. Now, depending on the build type, there can be either more or less risk. But I always remember the story of one of my music professors at university who was building a property. She'd bought the land, hired a builder to go and finish it, and then that builder went bankrupt. Now, what was okay is there was a master build guarantee. So somebody else, another builder, came and finished the property for the same price. But the issue is that because of that, there were significant delays. Now, when you're building in that way, what we call a progressive payment build, you are still paying the mortgage on what you've borrowed. So if you've borrowed money to buy the land and you've borrowed money to pay the builder, once the work stops, the mortgage clock keeps on going. You've still got to pay it. So there is a bit of risk there for new build investors that might scare them off. Now, if you're investing in a turnkey property, you don't have the same risks. But if you're doing progressive payments, there actually are quite significant risks there. And Andrew, I think all of this creates quite a toll on property investors.
Yeah, I think it'd be fair to say that it's a pretty nerve-wracking time to invest. Like, you have to make quite a lot of sacrifices if you're going to invest today. Again, you are going to get the benefit of a good deal because fewer people are investing now than a couple of years ago. But there are some sacrifices you've got to make. And if you're not happy to make those sacrifices, or you can't make those sacrifices, or if it's just going to keep you up at night, don't invest right now. That's okay. If something is not a good investment for you because it doesn't suit your lifestyle at the moment, or what you can tolerate as far as risks, I'd be the first to tell you not to invest.
Yeah, and I think this is all about taking what we're talking about today, all of the bad things, and putting them together with some of the more positive reasons to invest as well, so that you can create your own more balanced view. And I think the other thing that's important to recognize is we are often quite positive on this show because we hear investing for the long term. So is it likely over the next 10, 15, 20 years, in fact, I'm investing for like 30 years, is it likely that rents will stay flat over the next 30 years? Absolutely not. It is highly likely that they continue to go up at the long-term average. So I'm quite positive about the market because I'm not talking just about what's happening today and the fact that it's a bit tough. I'm thinking about, well, the rental market is cyclical. Sometimes the market is really good and it's very easy to find tenants. Sometimes it's harder. Sometimes it's really good. Sometimes it's harder again. And because of that, you can kind of look through the bad times and say, yep, this is what's going on right now. But in the future, I expect things to come right. And that's where you still can be quite positive, even if there are some reasons to legitimately look and say, well, those aren't great signs right now. The fact that the rental market isn't going so well right now. The fact that house prices, yeah, there are some early indications that house prices are rising, but is that just a seasonal effect? Well, we're going to have to wait for another 12 months worth of data before we can categorically say, oh, that's what was happening 12 months ago. When you're in the thick of it, you can't really figure it out. And so what I'd always say is, why are we so positive? Because we're looking at this over a 10, 15, 20-year period, as opposed to just saying, well, what's going to happen over the next 3 months? You've got to look through those if you are going to be a genuine long-term investor. Right, let's wrap it up there, but please don't forget to rate, review, and subscribe to the podcast. Really does help us get the message out to more people. If you're listening on Apple Podcasts or Spotify, you want to see some of the graphs we're sharing, just Google Opus Partners YouTube. It'll be the first thing that comes up. If you're watching on the YouTube, make sure you hit subscribe. We have smashed our goal of 20,000 subscribers. We've now got a big goal of 50,000 subscribers.
50.
That's what we want to get to over the next few years. Thanks for listening to the Property Academy podcast. I'm your host, Steve McKnight.
And I'm Andrew Nicol.
We're going to be back again tomorrow with even more daily strategies, tactics, and insights to help you get the most out of the New Zealand property market. Until next time.